All right, yes, I wanted to touch on the stages of probability. Now, that might sound very fake, but not fake. Might sound very vague, but I will touch on it exactly, and it will make a lot of sense, believe me. So the thing right here, and I have been trying to think about this on how I want to actually explain this for quite some time right now, and I think I have. You can correct me if I'm wrong, of course, because if it doesn't make sense, then please do tell me. But I have been thinking about how I want to fully explain it, and I think I know it. As in, we have 5 different stages of probability, and it's a cycle and it constantly repeats itself. So, in the current market, we can perfectly see, well, of course, since it's 5 stages and they repeat itself, we can constantly see it everywhere. We just need to understand where those cycles happen, etc., whatever happens. So, first cycle and the first stage of the cycle, let me use my anchored text actually. The first stage of a cycle is we have low probability conditions. And that is just very simply said, as in we have low probability conditions. That is the first step of a cycle. Again, does it need to be the first step? No, but usually it starts with low probability conditions that starts the new cycle, which is usually something like seek and destroy. Seek and destroy low probability conditions. That's usually what you see. That's usually the first step. Then the next step in that process is what we're having is we have a PD array. We have a PD array. Now, the PD array can be 2 things, right? As in, on GU right here, what we're seeing is we have seek and destroy at this moment in time. At that moment in time, we have seek and destroy. Why is that? Because we have a PD array in the form of a monthly value gap right there that we can potentially continue lower off of. So we can potentially look to trade towards that, but it is important to understand that that PD array at that moment in time, to trade towards it is low probability. Once we are in it, it's also low probability. And seek and destroy conditions happened because we have that PD array. So first stage is, again, this seek and destroy condition right here. That seek and destroy condition. Then the second stage is understanding that probabilities again. The second stage is also low probability. And we can dissect it even a little bit more, where this is the lowest probability condition. Let me remove condition actually. Then the second stage is low probability, which is that PD array. That is low probability, as in it is not as low as that seek and destroy, but it is definitely also low probability, because if we're coming into that PD array right there, then at that moment in time, we do nothing. As in, if we skip it a little bit back, at that moment in time, we're not going into the 15-minute, into the 5-minute to look for an entry. So it's still low probability. You didn't get the confirmation for shorts. We are inside a huge PD array, meaning that any discount array will likely get a rejection right there, or if you try to take a trade, it will not perfectly hold like this. Reason for that, because you can expect a big rejection of that monthly fair value gap right there. Even if it's a daily fair value gap, etc., you can expect some kind of rejection. Of course, if the daily fair value gap is based on current order flow as well, that is important to understand, because that means that the shorts right here, at that moment in time, we don't have confirmed shorts. So we have nothing to look at on the short side. On the long side, it is also low probability. So overall, it is low probability at that moment in time. Then the third stage is we have the ST. That ST is mid probability. And let me show you right here. That ST that we are creating is mid probability at that moment in time. And the reason for that again is that once we hit on the 4 hour, of course, we have not confirmed order flow just yet. So I always tell, and what I mentioned in the order flow video in this past enrollment, so that is the 5th enrollment actually, which lays the foundation, I would say, it is that once we have an ST going against us, it's almost like price and order flow in itself is 50-50 at that moment in time. Because you don't really have order flow going for you, you don't really have it going against you as well. So it is mid probability, because it's not low probability, but it's also not high probability. So at that moment in time, at this moment in time actually, because this is just a live market, that is low probability. Mid probability. That is mid probability, because we are not having confirmed, like actual 100% confirmed shorts. We also don't really have 100% confirmed longs. So at that moment in time, it's still 50-50, as in it's still mid probability. Of course, with the PD ray, with the ST, we can potentially say it's 60% bearish, maybe 40% bullish still. But for our trades, we want to at least have 100% bearish or 100% bullish. That is what we want to have. So that is what I would call mid probability. That is important to understand. For your entry, of course, right there, it is already low probability because you would not enter off a 4-hour ST on the monthly PD ray. But I'm aiming also at for your 5-minute ST plus RE inside that 4-hour ST, that is also mid probability right there. And the next stage that we are seeing is the fourth one, which the fourth one is, of course, our RE, which is high probability. That high probability stage is when we have that ST. After that ST, we have a retracement into a premium ray. We have a new order flow leg lower. Any premium ray that you want to trade off of. For the 4-hour entry, it is already high probability. But for your 4-hour fair value gap that is sitting right there for a 5-minute ST plus RE to then continue lower, that is also high probability. And that is basically because 4-hour order flow is then just confirmed, right? So that is high probability entries right there. Then the fifth and the final stage is we have our no resistance. I'm going to call it NR. It's no resistance. No resistance, meaning that it's the highest probability stage right there. Now, those highest probability stages, where do they happen and why do they happen? Of course, we have that ST. It's a mid probability. And if we go back to the third step, because that's important to understand first. The first thing, when we come out of a PD ray like this, we also have discount arrays still that are going against us in the form of that daily fair value gap right there, which hasn't quite been disrespected just yet. Yes, we're seeing early signs, but it hasn't been disrespected just yet. So what you tend to see right there is that we can still expect some kind of retracements, choppy price action, where the daily PD ray, daily fair value gap, is just still rejecting a little bit. It's still showing that signs of maybe potentially wants to be bullish. Of course, the PD ray, the monthly fair value gap that we're continuing lower off of, that will likely win. But if you get caught up in those choppy conditions still at that moment in time, then on the lower time frame, of course, it might hit your stop loss before it continues lower right there. That is important to understand because you have resistance still going against you right there. And then after that, and there was a beautiful example, and I will take you to the example really quick. On GBP Australian dollar, on the daily, I would argue we have no resistance anymore. So this order block right there is very high probability to continue lower. On the 4-hour, once we came off of that order block, what are we seeing? We are seeing that this moment right there, we have a 4-hour fair value gap going against us and a 4-hour order block right there going against us as well. That is the last resistance part. Because if we come below this low right there, then we have no resistance. As in, if we disrespected this order block, then we had no resistance anymore and would be a very easy delivery to continue lower. So taking that into account, you also want to adjust maybe your risk, etc. And of course, you want to also your break-even levels, etc., etc. Then for GBP US dollar, if we go back, then the thing we're seeing is that mid probability is currently in play. We have that ST, we still have resistance going against us. So for that RE, we have a high probability, meaning premium ray right there, continue lower off of that, because that also means that at that moment in time, we now have what? We have less resistance going against us because we have that RE as well, which is usually with that ST, what you see happen. With the ST, you see some resistance because that first discount arrays right there, they get the resistance of that ST. What do I mean by that? Once the ST is, of course, the first move likely out of the PD ray, out of the premium array in this case. When we move out of that premium array, what are we first going to encounter? The discount arrays that were still sitting there. So we have the ST, and we also mentioned that if we want to continue higher, we will likely continue higher off this daily PD ray, overlapping with the highs, etc. So this area, at that moment in time, is the first area where it's premium and stuck between discount. That is where your retracement likely will happen for your ST. As in, what do I mean? Let me fully break that down to fully make clear in my head as well, because I feel like I'm not explaining it perfectly. When we come out of a premium array, the first thing that happens is we likely create an ST. That ST comes into the first line of defense again for your bullish price action that came into the premium array, which then holds discount arrays. So if we want to continue lower, we will continue lower off the month fair value gap right there. If we want to continue higher, we will continue higher off of something like this. That ST that gets created in the meantime right there, and the retracement that comes from it, so if you get a retracement right now, that is because we're still getting that rejection, those last rejections off of those discount arrays. Because that, at that moment in time, that is 50-50 price action. That's mid probability again, because you're stuck between a premium array and the discount arrays. Then once you have that retracement happen, so you have the rejection happen off of the discount arrays. So it already happened, and that creates your re right there. Then the rejection already happened off of the discount arrays, meaning the discount arrays didn't follow through, so they are now weak. So when the discount arrays are weak, then you have less resistance going against you, and you have order flow on the bearish side now confirmed, making it high probability. Then the last stage doesn't necessarily need another re, but the 5 right there, the no resistance, is when we have the highest probability, meaning that we have absolutely no discount array going against us anymore. For example, we still have this fair value gap right there. That is still a resistance, as in we can still expect some kind of rejection right there. Not that it wants to continue higher off of that, but we can still expect a rejection right there. Once we have nothing anymore right there, and we are in between those lows, there's no discount arrays in that area, as in this area, there's just no discount arrays anymore. Then we have a very easy path to continue lower, which creates the highest probability price action, because then it's almost confirmed that it wants to deliver towards the drawn liquidity right there. So that is how you dissect and how you divide the different probability stages, the different stages of probability. And the thing I want you to understand here is that this is a cycle. This is a constant cycle that happens. And the next thing is that you can adjust your risk according to this. And you can also, of course, the person who is going to, how do I say that correctly? The person who is going to identify the cycles or the different stages the earliest is the one who's likely going to perform the best. And what I mean by that is that seek and historic conditions. If you can notice them as early as possible. For example, past few weeks, I think we've done a pretty good job at finding seek and historic conditions as early as possible, or identifying them really quick. So we were able to avoid the lowest probability conditions very easy. And then we can notice the next PD array, which is, or next stage, which is PD array. That again, we can identify that. We have also identified that. Then the next stage is that ST, and we identify that again. Then now, currently, of course, we have nothing to show for it right now. As in, we are currently in that mid probability in that third stage. That fourth stage, if you can identify the high probability and the highest probability stage as early as possible, and you're able to capitalize it on it because you can identify it as early as possible, then you will likely outperform someone that is struggling to identify the different stages. And that is important to understand, because once those high probability conditions are gone again, and we've taken those lows right there, doesn't necessarily mean that the high probability conditions are gone. If we still continue off a low that was off of a fair value gap that was overlapping with the low right there, that is still a high probability. But it is important to understand right now, if we don't respect that, or we continue higher, or we don't follow through, etc., then that again leads to your lowest probability price action. And if you can identify that as soon as possible, as early as anyone can, then you are a master at trading. Because that basically means that you are not going to take a lot of hits before you actually can identify the high probability conditions. That is key. That is very important. Now the next part is that The first two stages are not necessarily where you want to risk anything. So the 1 and the 2 is just out of play. You don't want to enter there. As in, you want to wait still. It's low probability, you don't want to enter anything. Then the ST right there, if you went to enter off the 4-hour ST with a 5-minute ST plus RE right there, then it is mid probability. Meaning that at that moment in time, you would ideally want to lower your risk. And the reason why is because it's mid probability. Now, the thing is that I want you to understand as well is that just because I tell you it is mid probability is, of course, who am I to say that it is mid probability at that moment in time? As in, based on my experience, based on my data, it is mid probability. If you gather your data and you see, hey, I always lose in the stage that Ario calls mid probability. Hey, I always win in the stage that Ario calls highest probability. So what do I want to do? Well, I'm still profitable in that mid probability section, but maybe I want to just lower my risk a little bit. Alright, I always win and I'm extremely profitable in the highest probability area. Why do I not just up my risk right there in those areas? Perfect. And based on that data, you can now say, alright, in that third stage, in that first ST area, I want to either wait or I want to lower my risk. Then at fourth stage, was correct? Then the fourth stage, what you can do is you can up your risk a little bit. So you can maybe go to 1%. And the way I see those risks is, for example, that third stage, you would maybe use 0 to 5%, 0 to 25%. Not really higher than that. Fourth stage, high probability, 1%. 0 to 5%, 1%. Depending on if you are in drawdown overall, etc. Of course, it also depends on that. Then the fifth stage is, I would say, 1%, maximum of 2%. Now, do you need to up your risk? No. You can also do mid probability with 0 to 5%, fourth stage, 0 to 5%, fifth stage, 0 to 5% as well. That's perfectly fine. But as long as you understand the different probabilities and how you can play around with that according to your risk as well, etc. So, that is very and extremely important to understand because this leads to your whole cycle. These are the market cycle, which then, if this is a market cycle, what does that mean? This is just, and to give you the why, to give you the whole thought process on how I come up with this, how I create these things, this, and not necessarily how I create this, but how I view it as well. Because this, understanding these cycles right here, these stages, let you to what? Let you to understanding a full market maker model extremely in depth, because I've never seen anyone talk about this before. Extremely in depth, understanding the stages, where they happen, why they happen, where it's the highest probability, where's the lowest probability, understanding the market maker model fully in depth without me labeling. I don't believe I've labeled a market maker model video inside the membership. And that is the sauce that we are teaching right here. And that is very important to understand. So essentially what we've done right here is the market maker sell model on the buy side of the curve is what? It's low probability because that is the first stage. Then the second stage is that reversal. It's that PD rate. It's that, how do they call it? The low risk buy, whatever it is. The unnecessarily difficult explanation of the market maker model is what we have just explained with the 2 stage. The PD rate, which is low probability right there. And the third one is the ST, which almost confirms that market maker sell model right there. But it's still mid probability. And then that RE is what we call just order flow right there, which we continue lower off of. That is the confirmed order flow. That is the confirmed market maker sell model. Then that no resistance, highest probability, is when we have no discount rate going against us, which is what? It's your silver bullet area. It's your silver bullet, and that's as easy as it is. It's magic. I love it. And that is where you have your quick runs right there, because we have no resistance anymore. We have no discount array going against us, aka your low resistance liquidity runs, because that is also where your silver bullet happens. Why are we seeing usually at the swing rates level the biggest consolidations right here? Yes, it's at equilibrium, but that's also where the most discount arrays are. And then here, why are we seeing no retracement or barely retracement, staying into it to then continue lower? Because that is usually where there's no resistance. There's no discount arrays holding us back anymore. So this is how you can fully digest it. Use this to your advantage. And the last thing that I want to touch on, this is also your whole psychology guide. And what I mean by that is, this is just a little thing, you could call it sneak peek. I don't really want to call it sneak peek because I'm not hiding anything for you, but sort of a sneak peek for the next enrollment and how we are going to work on it, etc., etc. Not necessarily this as well, not only this, but a lot of things that are very easy to understand and a whole new light on it. And that is very important because it's still the same stuff, still the exact same stuff. But the way we view this is that seek and destroy, lowest probability, it's usually when you can identify it. So you haven't blown your account, you're not in drawdown yet. Perfect, you did a great job. If you can manage to identify it correctly, then again, I would say, all right, it's pretty easy to stay out of seek and destroy conditions because it's pretty easy. You're like, all right, seek and destroy, don't have to do anything right now. Pretty easy to stay out. Then once we approach that PD ray, it is still pretty easy to stay out, but you still have a little bit, from my experience, again, when I say you, I'm mainly talking to myself. When I say you still have a little bit of that FOMO, as in it's coming in, as in it's in the PD ray, do I need to do something? What do I need to do? Then the third stage is that ST. Once you have a rejection like this, now you're probably like, oh shit, I need to get in. Where's my MetaTrader? Boom, boom, boom. Let me execute right now. Boom, 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 boom. That is, again, where you still need to understand that is a lot of FOMO. You're not missing out on anything. If you miss out, you might miss out. Who cares? Because these things happen over and over and over and over and over again. The whole year we've been talking about it, and the whole year it's happened over and over and over again. So you're not missing out because there's another opportunity to come. And if you miss out, great. Great, great, great. It's a great learning experience. So that right there, there's a little bit of FOMO of like, it didn't even come into a primary just yet, as in the ST didn't even come into a primary right there. So you couldn't even capitalize on it, but it's almost like I instantly want to market execute right there because I want to get involved, etc., which is not part of your plan, which is something you should not do. From my experience, if I do not stick to my plan, I trade outside of my plan, usually 9 out of 10 times, and it's like God's work, you could call it. It's like the market's work. It's market punishing me. You don't stick to your trading plan, so you are going to lose. And once you decide and once you learn to stick to your trading plan, then you are going to see the fruits of the labor, and you are finally going to see some wins, and you're finally going to see some profitability. That is very funny how that works, because that is from my experience how it works. Then the fourth step is that re. And that re, if you have been patient, as you have been waiting for that re, then it's of course also important to understand that once you've been waiting for that long, or maybe long, who knows how long it took. Of course, if it's monthly context, it will take longer to wait. But if you've managed to wait, not blown an account, not in drawdown, alright, you did a pretty decent job. Now, can you actually capitalize on it? Again, you can see how much exposure there is to your psychology, to almost the stars need to align in order for you to be profitable right here. And it's not saying that I'm not saying that it's impossible, but it's a huge learning curve. A lot of people think that you come into the market, I just do this, I'm profitable. No, it's like there's a lot going into it. And that is very important to understand, because once you have that re right there, doesn't necessarily mean that you can capitalize on it. You might still get taken out. You might still take a loss, of course. High probability doesn't mean that you will. High probability doesn't equate to win. Low probability doesn't equate to loss, but it's understanding those probabilities. Is price in my favor, etc.? Are the odds in my favor? Then the high probability stage right there is where we have where we might be afraid a little bit to enter, because we've been waiting, we've overcome that FOMO, and now all of a sudden we need to do the opposite of what we told our mind. As in, we first need to tell our mind, we need to stay out of the market, there's nothing there, we can't get involved just yet, And then all of a sudden, we need to switch our mind and we need to be like, we need to get involved, we need to get involved, we need to do something, we need to look for an entry pattern. And then your mind is like, what? Why are you telling me these contrary things? What are you doing? Why are you such a hypocrite? What are you doing? Like, no, we're not getting involved. And then it's almost like your mind is holding you back. Like, should I take this entry? Do I really trust it? Is it really high probability? And again, those are the beginning stages of actually becoming a trader. So if you experience that, nothing wrong with it. It will become easier once you do it more and once you get exposed to it more, etc. So that is also important to understand. And once you do capitalize on it, then it's important to understand that your confidence will rise. As in, you have high probability, highest probability. Oh, there's nothing holding me back. I am going to capitalize on every single move from now on. I'm the best trader in the world. Let me post this on Twitter real quick. I just made $5,000 on this beautiful GU setup. Who is going to tell me whatever to do? Who's ICT? Who's Ario? Who's those guys? Screw them. Who are they? And then the next thing you know is you take a loss and you're like, I took a loss? What? Let me recoup that loss real quick. And next thing you know is, hey, I took another loss. Why did I take another loss? Let me up the risk a little bit and let me recoup those losses. Let me brag about it on Twitter because I can't go down like this. That's impossible. Next thing you know is you blow that account, you zoom back out because now it's not from trade to trade. You zoom back out and then you're like, we were in seek and destroy conditions, in the lowest probability conditions for my trading plan. Okay. That says a lot, right? And then that is very important to understand because if you get confident, too cocky, too confident on those 4 and 5 stages, and you have that highest probability, you need to be aware that at a certain moment in time, low probability conditions will come back into the market. It's extremely important to understand. And that is why I mentioned, and you see me talk about this, last week or the week before, where on New Zealand dollar, US dollar, I was like, I don't really trust it. Like, once we had this move from this daily fair value gap right there, we had high probability conditions. So we had monthly fair value gap continuing lower right there, took monthly context low, daily fair value gap right there, took daily context low. Then after we have potentially the 4 hour as well right there, and we can continue lower off that. And I mentioned at that moment in time, I do not want to take that trade here off the 4 hour to potentially continue lower. No, because I don't trust it anymore. As in, price showed me so much high probability conditions that it's like, really? Are you really going lower again? Are you really going to is the market that perfect? No, it's not. So again, of course, that is very subjective. And the way we came to that conclusion is, of course, the lack of creation of daily fair value gaps lower, the weekly fair value gap as well above it right there. But that is how you need to view it. As in, it's almost like you need to constantly be in that very, very alert stage. As in, are you really high probability conditions right now? Is the market really high probability condition? Is it really true? And that way you keep your confidence in check, and you are the first person to identify whether something is low probability. Because now at that moment in time, we said that this week was low probability. Reason for that, we can potentially trade towards the weekly fair value gap, but that is not the highest probability trade that will happen. So at that moment, we have seek and destroy, which is the lowest probability price action to happen right there. Which is exactly what we saw, of course. And that is, again, once you can identify the very early steps, and we were able to identify it at that moment. So it was almost perfect. And if you can do this, then give yourself, and I would love to give you some pat on your shoulders or whatever, just to support you, because it's super, it's beautiful. It's if you can identify the highest probability condition ending at that perfect moment, you identify low probability conditions, which we did right there, then that's like, wow, you did an extremely good job. And now you can understand again, low probability conditions, PD rate, low probability, ST, mid probability, high probability, and then no resistance, highest probability again. And that is how we go about it. And this is very important to understand as well. And this is constantly what happens. We also saw it here, right? Where we have this lowest probability, PD rate, low probability, mid probability right there. Then we have the high probability. We had a daily VWAP gap above that. That would have been higher probability, of course. Then we have the highest probability right there. And then right there, we immediately identified lowest probability. Boom, take a step back. And that is what we need to understand in the current market price, but not only in the current market price, because this happens all the time. Very important to understand. Hopefully this makes sense, and this is something we will build on more and more as well. All right, perfect. Thank you.